Well, hello and a very warm welcome to this webinar showcasing Scope Ratings 2026 Sovereign Outlook, which we've subtitled Europe Showing Resilience but Significant Risks Ahead. My name's Keith Mullin and it's my pleasure to be your moderator today. And I'm absolutely delighted to be joined today by three analysts from Scope's Sovereign and Public Sector Ratings team. So let me introduce you straight away to Carlo Capuano, Eiko Sievert, and Thomas Gillet. Now, in a moment, we'll take you through a presentation that'll focus on a number of key current themes, including can Europe raise its growth prospects and address fiscal pressures, and what are the main political, geopolitical, and market developments that have shaped our sovereign credit outlook. Now, after the presentation, we'll be delighted to take your questions, so please type these in as we go along, and we'll get to them later. And we'll be publishing the Sovereign Outlook tomorrow morning, but as a special offer to you, our viewers today, we'll be delighted to offer you exclusive early download at the end of today's session, and that will become clear towards the end. So that's it from me. Carlo, Eiko, Thomas, it's great to see you. Thanks so much for your time today. Carlo, I believe you're going to kick us off, so let me hand over to you.
Yes, thank you. Thank you very much, Keith. Well, assessing the sovereign outlook is typically a matter of identifying the risks, the opportunities, the headwinds, and the tailwinds that could shape the sovereign credit quality of our portfolio. But let me start with what has happened so far. We have seen, 25 dense of events with the US decision, for example, to increase significantly tariffs, which we think will only partially compensate for the expansionary fiscal policy. We have seen persistent fiscal challenges in France, and for example, these two factors, including weakening in governance, led us to downgrade the US and to place France on negative. But we have seen also pocket of resilience, particularly from Southern European economies, which thanks to robust economic growth have been able also to make progress in improving, their public finances. And this led us, for example, to place Portugal, Cyprus, Greece on positive outlook. This is why, if we look at the chart on the left, we see pretty symmetric, rating distribution in 2025. If we look at the chart on the right, we see our distribution for outlook, which is as well symmetric, and this reflects a trend that we see at the moment, which is the rating convergence trend. So if, for example, we look at the chart on the left, and if we compare the rating level in 2019 for Euro area countries with the rating level at the moment in 2025, we are seeing that for those countries that typically are rated at a low level, like Greece, Cyprus, Portugal, we have seen an improvement in their credit quality. On the other side, countries that have been typically rated at a high level, like Austria, Finland, Belgium, have seen a deterioration in their credit quality, or we expect a deterioration in their credit quality. So we think that this rating convergence trend is going to continue going forward. But despite that, in our view, the sovereign outlook for 2026 is negative because we see risks more tilted to the downside. We identify three major risks. Number one, geopolitical tensions. We think that the trade war game is not over. It's possible, an escalation of tensions again between China and the US. We see potential, decision from China to tighten exports of rare earths, which will negatively affect supply chains. The second risk is political polarization. We are approaching elections in 2026, but in particular in 2027, there will be several elections in Europe. And we think that political polarization does not bode well for implementing those reforms that are going to increase the potential of the economy. Last risk is fiscal challenges. Beyond the US, we see also fiscal challenges for European countries, in particular due to aging costs, additional defense expenditures, but also interest costs. However, we might see also positive news. So, in particular, growth might be stronger than expected if, for example, there is a boost in the reforms, or at the same time there are improvements in the deregulation that could make more efficient the business environment. But we see also a pocket of resilience, again, from Southern European economies, which can benefit from the NGO acceleration, and also potential higher than expected spillover from Germany, which has a significant fiscal space to accommodate the increase in expenditures. So with that, I will give the floor to Thomas and Eiko that will give you the details. Thomas, the floor is yours.
Yeah, thank you, Carlo. And starting with the first risk that you mentioned, geopolitics, that will remain a downside risk for the sovereign credit profiles in 2026, but even beyond that, because of the intensification of global economic competition from the US, China, and because of military tensions in Ukraine and across Europe. So starting with the US, the second term of President Trump has significantly accelerated global fragmentation by reshaping trade order with international tariffs, but also by relying on US dollar to introduce international sanctions and by reconsidering military priorities. So first, US tariffs increased significantly from an historical perspective, but have remained lower than initially planned in April, as you can see on the first chart. We see that the US secured trade deals in 2025, but the US trade policy is expected to remain unpredictable as it continues to be used to advance the US policy agenda. Then the US dollar remains by far the main reserve currency globally, and that gives to the US administration a strong power to introduce economic, financial, and individual sanctions, which are effective given the extraterritoriality of the US law. And we expect the US to continue using sanctions as a key policy instrument. And third, the US remain by far the leading military force within NATO, with more than 2/3 of overseas US military forces located in Europe. But we see now also that the US security commitment vis-à-vis Europe is more uncertain under the current US administration. So our baseline on the US is that the US policymaking will remain volatile in the near term, even though US policy continuity is uncertain over the medium term, which is a key difference vis-à-vis China. So moving on with China, I will be very brief on that and why it matters for the EU sovereign outlook. First, China continues to intensify global economic competition by increasing its share in global GDP at the expense of the EU and the US, as you can see on the first chart. Then both the EU and the US are very much dependent on China to get access to highly strategic materials for climate and digital transitions. And third, most of the global chip manufacturing capacity is projected to remain located in Asia by 2030, which is also a challenge for EU strategic autonomy and resilience, as you can see on the last chart. So our baseline on China is that the country will intensify global economic competition vis-à-vis the EU, but also the US, and that China will also remain an important stakeholder in the military conflict in Ukraine, given its relations with Russia. Russia has a long-standing economic strategy based on its large natural resources, but the focus has shifted since the full-scale invasion of Ukraine. And this conflict obviously drives our economic and financial projections for European sovereigns. First, Russia energy exports were skewed towards the EU, the UK, and the US, but exports shifted towards emerging markets because of international sanctions. And on the first chart, you can see that China and India now account for more than 50% of the Russian oil exports. And we think that any scenario in which there is a ceasefire would probably require China and India to moderate or even stop buying Russian fuels. Then the evolution of the military conflict will also depend on ongoing negotiations between the US and Russia, but also on European financial support to Ukraine. And one key topic for 2026 will be about mobilizing Russian frozen assets for a potential reparation loan from EU member states to Ukraine. And third, one key challenge for the EU will be to support Ukraine in terms of armed deliveries, but also in terms of recovery and reconstruction, with estimates steadily increasing above $500 billion US, as you can see on the last chart. So on Russia, our baseline is that the country will remain out of global economic competition because of international sanctions, but will continue testing Ukraine military resilience and the cohesion of NATO and European member states, especially ahead of major elections. So moving on from geopolitics to politics, let's have a quick look at the electoral calendar in the US with the midterms in 2026, but also in Europe with parliamentary elections in Hungary that will be important for the EU budget negotiations. Then in 2027, there will be the French presidential election that we consider as one of the most decisive European political events over the coming years. The focus will then shift back on the US in 2028 with the presidential and parliamentary elections, and on Europe again in 2029 with the German and the EU elections. So when it comes to European elections, the outcome will be key to advance the EU policy agenda and reinforce the EU resilience to cope with geopolitical tensions. What is clear here is that the EU has very strong democracies, but there are downside risks related to growing political fragmentation and polarization across Europe. And we think that this is a concern for sovereign credit profiles in the near term because of difficulties to pass the annual budget in some countries, but also over the medium term as political fragmentation and polarization could drag on the reform momentum to tackle domestic credit challenges. As you can see on those three charts, the key questions for the coming years are about one, the outcome of the presidential election in France and potential victory of the far-right party. Two, the impact of Spanish highly fragmented parliament on policy making. And three, the future of the German government coalition until next elections in 2029, and more specifically, the capacity of the political opposition, AfD and Die Linke, to maintain a blocking majority. So our baseline is that the EU political outlook will be challenging given major elections that will be decisive for the cohesion of European member states and also for the effectiveness of EU decision making. Last but not least, the US political outlook, where the key determinants relate to the strengths of domestic institutions, the midterm elections, and the risk of a debt ceiling crisis. First, The US governance standards have weakened, particularly given the erosion of well-established checks and balances, which reduces the predictability but also the stability of US policy making. We consider that the consolidation of powers within the executive branch increases the risk of policy missteps, including from the Federal Reserves, whose current share is set to step down in May 2026, and that will obviously be a major event to inform the US inflation outlook. Then one question mark in the US is also about the outcome of midterm elections and the ability of the Democrats to build on the recent electoral momentum to secure a majority in the House, whereas the Senate is likely to stay Republican. And finally, what will shape the US outlook is the risk related to a debt ceiling crisis, given the high polarization between the Democrats and the Republicans. And as you can see on the third chart, the US recently raised the debt ceiling, and the country went through the longest government shutdown in history. And our baseline on the US is that both the federal budget and the debt ceiling will continue to be heavily politicized, possibly with another government shutdown in 2026. So I leave it here for the European and US political outlooks so that we can move on with the growth and fiscal projections. So over to you, Eiko, for an update on our projections.
Great, thank you very much, Thomas. So in light of these geopolitical and political challenges, as mentioned, I wanted to briefly take you through our baseline expectations. And in particular, I wanted to give an overview of the growing fiscal challenges that we see for many sovereigns in 2026, but which will also stay with us over the next couple of years. And related to that, I, of course, have to also mention our economic growth expectations and some of the recent financial market developments. So since the pandemic shock in 2020, we have seen quite uneven growth across major economies. So in the US, the US has expanded quickly since then, while the euro area has grown much slower, as you can see in the first chart, which also reflects the longer-term structural challenges tied to aging populations. One economy that stands out on this chart is Germany, where economic output in 2025 is essentially at the same level as 6 years ago. That reflects an unprecedented period of stagnation for the country. The reform of the debt brake will allow for increased government stimulus and should also support stronger growth in the next years, even if catching up with the recovery in other large European economies looks quite challenging. For 2026, we expect above potential growth in the euro area of 1.3% and in the US of 2.4%. In the US, partially supported by a rebound in the first half of the year following the end of the long government shutdown in November. And finally, in China, we also expect about 4.7% growth, which is also slightly above potential. In the UK, we expect below potential growth of 1%, both for next year and also for 2027. Globally, GDP growth is therefore also expected to be above potential in 2026 and up about 3.2%, even if slightly lower than in 2025. For 2027, we expect most countries to see a slight slowdown in economic output. And clearly, US tariffs have dominated the headlines in 2025, and this is also that has also weakened growth in Europe. But for most economies, the shock in itself has been manageable. Of course, it did not come in isolation. And going forward, increasing competition from China is said to be a particular challenge for many European economies, holding back growth. And that's particularly in export-led economies such as Germany, which is illustrated on the third chart on the right. Important to note are the significant internal barriers within the EU that we still have. So growth could be significantly boosted if there was a stronger focus on increasing labor mobility, deepening capital markets integration, improving energy policy cooperation, and then also more generally reducing regulatory fragmentation. And there has been progress. So, for example, the agreement to harmonize EU insolvency laws agreed just last week And we expect this also to continue, but in the current volatile and challenging global environment, it would certainly be beneficial if such reforms could be implemented even faster. So while EU-level reforms are crucial to enhance the bloc's integration and also its competitiveness, individual member states are also facing significant structural spending pressures. In some cases, these are challenging to address because of the points already outlined by Thomas, such as the political polarization. And on defense, for example, so meeting NATO's 3.5% of GDP spending target will require around 300 billion of additional annual funding. And committing such funds will require political sensitive trade-offs against other priorities, such as welfare spending in Europe, aging societies, and the unavoidable rising interest burdens on high debt levels in many countries. This is very evident, for example, in Spain, which you can see on the second chart, who have, however, openly opted out of the higher defense spending commitments. But it will also become more relevant over the next years in countries such as France and also Italy, who are both facing high debt levels and the associated high interest burdens. And we should bear in mind that the 3.5% of GDP spending target is, however, set for 2035. So that means in terms of US political cycles, we should see another 2 presidential elections before the target actually becomes binding. One country clearly committed to higher defense spending is Germany, and the reformed debt brake and also the significant fiscal space make this possible and achievable. Over the medium term, it will be important that the higher military spending is also sustainable from a budgetary perspective, and that it is not continuously debt financed over time. Here I wanted to illustrate the fiscal pressures across countries. And we expect most EU sovereigns to consolidate their public finances over the next 5 years. So those are those shown in the top half of this chart. And countries that are easing, so in the bottom half of the chart, mainly include, first of all, those who are likely to still maintain a primary surplus by 2030. So for example, Cyprus, Greece, Ireland, Portugal. Or second, those who still have relatively low public debt. So for example, the Baltics, Germany, or also the Netherlands. And to highlight 2 large non-EU countries here, so the US fiscal position is expected to remain quite challenging with little fiscal consolidation over the next 5 years, and still a very high primary deficit by 2030. And for Japan, so here we see a worsening primary deficit as interest rates start to increase on the very high public debt levels in Japan. And the new government is also likely to further add to this deficit, although the budget discussions here are clearly still ongoing. Clearly, the primary balance is only part of the picture. So since the end of the low interest rate environment, interest expenses have started to rise, and this will continue across most sovereigns over the next years. And the chart on the left here shows the pre-pandemic level of net government interest payments as a share of government revenue. So how much of the budget is allocated towards interest payments. And here we see that this interest payment burden by 2030. And in some countries, such as the US, Hungary, China, France, Japan, and Finland, all shown in red, you see the bars getting very close to the yellow dots, which indicate the peak interest burden that we've seen in the past 25 years. So governments in these countries will face difficult political choices as a higher share of the budget must then be allocated to meeting interest payments at the expense of social and other spending priorities. And so why do we see these differences across countries? There's no simple single answer, as many factors such as primary balances, yield developments, GDP growth all play a role. But just to illustrate one important factor, so the average government debt maturity varies significantly across countries. So those with a high debt burden and a relatively low average debt maturity, such as the United States, for example, will see a faster increase in their interest payment burden compared to others. So what does all this mean for debt to GDP ratios and debt to GDP developments? So just to briefly explain this colorful chart, the light blue bars show the ratio, the debt to GDP ratio in 2019. The dark blue bars show the impact of the COVID pandemic in 2020, which increased debt ratios pretty much across all sovereigns. Then the striped green bars then show the developments after the pandemic. So most sovereigns here managed to lower their debt ratios over this period. And then finally, the red bars show how we expect the debt ratio to change until 2030. And in terms of the red bars, you can see quite a bit of divergence across countries and also rating categories. So we see continued significant debt reduction in recently upgraded sovereigns, so including Greece, Cyprus, Portugal, and Spain. And most of these are in the single A category. And in contrast, we see continued pressure in many countries in the double A category, so including Austria, Finland, the UK, France, and also the US. But also Belgium, which was downgraded to A+ just over a week ago. The challenges faced by these countries are quite similar. So first, challenging fiscal outlooks due to the high structural spending pressures, and then also the difficulties at addressing these pressures, partially also because of either deteriorating governance or rising political polarization. And a final point to note from a sort of macro fiscal perspective are the recent financial market developments. So there's been a lot of noise about a potential AI bubble. And looking at price earnings ratios, it does indicate elevated valuations that are not too distant from the peak dot-com bubble levels. And there's clearly also a very high concentration in terms of market capitalization in the S&P 500, especially within the magnificent 7 tech companies. And to bear in mind, these charts go back more than 100 years. So many of the bubble fears appear warranted, and it seems likely that we will eventually see a market correction, even if the timing obviously remains highly uncertain, unless, of course, earnings from all this AI investment really does increase significantly. And there are significant vulnerabilities that could crystallize when such a bubble bursts. So one is the direct wealth effect that investors will feel, which could lead to lower consumption and also lower economic growth. But in addition, there are potential vulnerabilities from structural changes in financial markets over time. So for example, the growing importance of non-bank financial intermediation. So this increases uncertainty how such shocks are transmitted and how they spread also across different asset classes. But diving into this in sort of full detail would probably require a separate webinar. So with that, I would for now hand back to Carlo to conclude.
Yes, thanks, Eiko. Let's just conclude with some scenarios that we have performed on what could happen in the next couple of years. So these scenarios depend mainly on 2 outcomes. One is whether the EU mainstream European parties are able to secure elections and at the same time make significant progress on the reform agenda. And the other outcome is whether the US institutions are able to withstand basically the current US administration decisions, which are generating, uncertainty and volatility. So to give you some details, at the moment we are in scenario number 4, in which European mainstream parties are in power, but it seems that there is the pace at which they are implementing those reforms, in particular those related to the Letta and Draghi's report, basically are not significant, and at the same time there is a lot of volatility and uncertainty generated by the US administration policies. To give you some perspective, last year we were basically in scenario number 3, in which still there was complacency at the EU level in terms of the reform agenda, but we didn't have the same level of volatility and uncertainty from the US administration with the Biden administration. Clearly, scenario 1 and 2 are more positive. So in those scenarios, we see European mainstream parties securing elections and making those reforms, in particular, for example, making progress with the investment and saving unions in order to channel private sector, investment to the real economy, strengthening the energy independence of the European Union, and also on the security side. On the other side, we have clearly downside risks which are scenario 5 and 6. In this case, European mainstream parties lose the elections. We see more populistic, nationalistic parties increasingly shape the political narrative, the policy outlook. In this case, we think it could be very difficult, to move ahead with the reforms in order to increase, the potential growth rate of European economies. And in scenario number 6, we might see even, a reversal of EU integration, less commitment to Ukraine, and at the same time, we can't rule out potential, escalation with Russia. Of course, we can't rule out also another elephant in the room, which is China and its foreign policy, as we said before, the potential decision to tighten, exports of rare earths, but also what could happen on Taiwan that might generate, tensions with the US. So overall, we think that our future will depend on the decision, of European Union citizens when they go to vote. What, of course, parties will do, but at the same time, whether or not the US institutions will contain the unpredictable policies that the US administration at the moment is implementing, and also what will be the foreign policy from China. And with that, I will hand over to you, Keith.
Great, thank you very much, Carlo, and thanks also to Eiko and Thomas for covering some pretty broad themes in a very insightful fashion with some great charts as well. So to our viewers, thanks for staying with us so far. There is still time to ask your questions, so please type these in, and I've got a few already lined up. So look, gentlemen, a lot of the questions here are pretty sort of general, broad, macro, but there is one quite specific question I wanted to come to straight away, which perhaps, Eiko, if I may come to you on this one. Simple question: under which circumstances would you touch Germany's AAA rating?
Sure, yes, happy to take that. Thanks. If we could maybe go back to the slides briefly, I just wanted to illustrate something here.
Sure.
Just to go back at the debt to GDP ratios that we expect, it's a warranted question, given that if we look at the AAA universe, Germany is expected to have the highest debt to GDP level here compared to the other AAA rated countries. But Germany, as a benchmark issuer in the EU, does also have a high degree of funding flexibility. So clearly in Germany, we have seen this big fiscal stimulus package announced following the changes in the debt brake, and also particularly the increased defense spending. I think the actual spending of these funds is a little bit slower than we had initially expected, which is partially the challenges of implementation as well, and of actually going through the bureaucratic processes of spending funds. But in terms of where we see the debt level going, so previously, so at the moment, the debt to GDP in Germany is about 63%. Before the changes in the debt brake, we were expecting this to drop below 60% over the next few years. Now we expect it to increase to just over 70%. So that is, it is a gradual increase. It's still a manageable increase. Where I think longer term, the pressure on the AAA could increase is if so the difficult structural reforms that are still needed despite this increased fiscal flexibility, if these are not addressed, then there will eventually become growing pressure on this rating. And in particular, defense spending. At the moment, this is excluded from the debt brake. So up to around 2 or 2.5% of GDP could be spent purely through debt financing, with the rest being in the ordinary budget. If this is continuously debt funded, then that will ultimately put upward pressure on the longer-term debt trajectory as well. So our hope is that the government will be using this time that it has through the fiscal flexibility to also implement the difficult structural reforms.
Yeah. Okay, very good. Yeah, thank you very much. Carlo, in your section, you talked a bit about the populist parties and their potential success in elections. Like, I guess that the inference here, correct me if I'm wrong, the inference is that the victory of populist parties could actually be a negative factor for Europe. And I guess it's just, I guess, an overtly political question in some respect, but why are you so pessimistic? Could populist parties actually do better than expected?
Yes, yes, of course, of course. I think clear example is maybe in Italy with the populist parties, including Lega and Brothers of Italy, probably being when they are in power, probably they face the reality and they can start to take a more responsible approach. We have seen this in terms of fiscal prudence in Italy, and of course this could happen also in other countries. But I think it's unlikely that if we see populist parties securing election in several European countries at the same time, they could be able to make the collective effort to bring forward the EU agenda, which requires more coordination, which requires costly reforms that go beyond their countries. So for this reason, we think that this scenario is a bit unlikely at this stage.
Yeah, absolutely. Yeah, makes sense. And Thomas, staying on the political theme, you talked about the French presidential elections and perhaps referring to the French political, issues. Why is the French election so important for the European sovereign outlook? Bearing in mind, it'd be important, maybe the EU, but a single country.
Yeah, so on France, as I said, French presidential election in 2027 will be, very important for the EU sovereign outlook because, when we look at France's historical leadership in the European project, for example, and the importance of the country in terms of European economic, financial, but also security architecture, that will be very important. And when we look at the numbers, France makes up about 15% of the voting rights in the EU Council, and it's one of the largest contributor to the European budget. So that will be, as you mentioned, Carlo, very important for the EU reform agenda. And so now in terms of risk, I think also, the main risk, at least in the near term, is that France's influence across the EU is somewhat reduced by a challenging fiscal and political outlook, and also the difficulties to advance the domestic reform agenda. So I think it's more difficult for France now to shape the EU reform agenda, especially vis-a-vis EU partners having fiscal space and EU partners having sustained reforms over the past 10 years, especially in Southern Europe. So
yeah, okay. Very good. Jumping around a bit, there's a question about financial markets. Now, you did touch in your presentations, perhaps not too much on the financial market response, but maybe I could pose this one back to you, Eiko, which is, why haven't we seen more of a correction in financial markets so far, given some of the kind of pretty broad challenges that you all outlined? It's not just we've seen a huge increase in corporate bond issuance because of low credit spreads, but I guess if a big correction were to happen, focusing perhaps on equities, how would a change in equity prices lead to problems for sovereigns? Is there a kind of direct link you can posit there?
Sure. Maybe we can just go back to the financial market slide again, just because that helps to illustrate it. So if we, what you can see, let me just
Yeah, perhaps you can move up. Yeah. There you go.
So you can see that the rise in the price earnings ratio hasn't been as rapid as during the dot-com bubble. And in a historic context, however, I would still expect this ratio to come down eventually. And I mean, essentially, there are two ways this ratio could come down, either by prices falling or by earnings rising. Earnings rising is also a possibility. I mean, growth in the US has been quite robust in the past couple of years, as I was illustrating earlier. We are also likely to see further interest rate decreases in 2026, which will support continued increases in share prices. And the deregulation drive that we see in the US, but which will also spread to other jurisdictions, can also support growth. Although clearly there's always a pinch of salt with these deregulation drives, because if you go too far or too fast, it can result in financial imbalances building up, which then can ultimately lead to instability in the longer term. Also, as I mentioned before, there, in terms of what the impact would be if such a more severe market correction were to happen, is first of all that you could see this direct impact through a wealth effect, so lower consumer spending, and then also slower growth from that. But also in terms of the financial markets and the changes, the structural changes that we have had there in the past years and also decades. So as an example, over the past few years, Cayman-based hedge funds have very significantly increased their purchases of US treasuries and also of European bonds. And so if there were sudden market corrections and these hedge funds were therefore forced to adjust their positions, then this could also magnify instability in sovereign bond markets.
Yeah. Okay, good. Thank you. Carlo, we have a question about the ECB and asset purchases. And the question is this: how important for euro area ratings is the ability of the ECB to conduct different asset purchase programs in times of crisis, activate TPI, or use outright monetary transactions? Do you want to have a go at a response there?
Yes, I think we have already seen in the past, how, ECB, even the statements from the ECB governor, had an impact in terms of cost of funding, reassuring the markets. So I think this is quite important, particularly for those countries with a high level of debt and high sensitivity in terms of interest costs, as Eiko also showed in the slide. For sure, if the ECB is able to expand, its balance sheet is also important, because this means that typically the ECB might purchase assets that are less sensitive, to political environment in its balance sheet. So this means that a larger share of debt is in the hands of a holder, which does not immediately sell the debt when there is volatility on the market. So I would say it's important on one hand in terms of the cost of funding, second of all to reassure markets, but at the same time is we can say that these institutions typically are long-term investors, so they maintain their debt, basically their holdings for some time. They don't sell immediately when there is political volatility, for example.
Yeah. Okay. All right. Thank you, Thomas. You did address some Ukraine issues in your presentation. I got two questions, which I'll perhaps roll into one. Now, obviously, this notion of financial assistance to Ukraine is out there. It's a challenge for EU countries. How challenging will it be, or perhaps how important will it be for Europe to support Ukraine? That's the first question. And perhaps more pointedly, how could these ongoing peace negotiations we keep hearing about between Russia, Ukraine, US, EU affect the EU sovereign outlook? So apologies, two questions there. Perhaps you can address them in order. So how challenging or important will it be for Europe to support Ukraine first?
Yeah, so I mean, that's a tricky question. But so first, now I think U.S. security commitment vis-a-vis Europe is more uncertain. That's clear. And I think also that will remain a game changer for the EU in the sense that the EU will need to build up its own defense capacities and provide more financial support to Ukraine. So, I mean, when we look at the numbers, roughly speaking, financing gap to support Ukraine is about $150 billion for 26-27, which is a financial liability for the EU. And obviously, then the very difficult question for EU member states is how to close this funding gap. And we see that there are some options on the table, including using Russian frozen assets or EU debt backed by the guarantees from member states. So let's see what comes out of the ongoing negotiations with Russia and the US, also from the EU Council in December. But what is clear to me is that there is an overlap between the credibility of EU member states to provide financial support to Ukraine and ongoing peace negotiations, in the sense that what is at stake is not only, the financial support to Ukraine for the next 2 years, but also the ability of the EU to be part of those negotiations, which are critical for European security architecture in the long run over the next 10 years. Let's say.
Yeah. Okay, and on the sovereign outlook, peace negotiations and sovereign outlook, can you just, in a sentence or two, summarize, just so we're clear?
Yeah. So on the ongoing peace negotiations, I mean, that's difficult to comment on that, and it's ongoing. But I think here's our baseline is that Russia is likely to remain a long-term challenge for European member states in terms of security and cohesion, because of the ongoing military operations in Ukraine, but also because of the risk of potential escalation in Eastern Europe, and also because of this hybrid war with targeted operations across the main EU countries, and one can think about Germany, France, and Poland. So that is likely to continue, even if there is a peace agreement at some point in Ukraine.
Yeah, absolutely. Okay, so we actually have a question. We have a question about what a potential far-right government in France might implement in terms of its policy program. I think we're going to steer that one. That's a little bit pouring speculation on speculation. So thanks to our questioner, but we are going to swerve that one respectfully. I do have one more question, which I guess I can throw out there, but maybe I can go back to you just on this one. Again, we talked about the weak fiscal outlooks in some of the large developed sovereigns. In the back of your mind, or perhaps in the front of your mind, do you have concerns that we might run the risk of a renewed sovereign debt crisis?
Yes, thanks, Keith. So I mean, while we have a negative sovereign outlook, and we clearly have weak fiscal dynamics in many sovereigns, and also there are clear downside risks from a political perspective. I would not automatically conclude that the next sovereign debt crisis is immediately around the corner, but still, I mean, market confidence and bond markets can swing quickly, and governments face a very difficult balancing act between sort of lowering budget deficits and then also stabilizing debt levels, while also meeting this high social spending promises that they've made to voters. So implementation of this will be pretty key, not just from a fiscal sustainability, but also from a political stability perspective. And then also how governments address these pressures is closely watched by bond investors. And if they lose patience, it certainly could lead to sort of sudden market sell-offs. But as Carlo had mentioned in a previous question, we also shouldn't forget that the ECB, for example, has expanded its toolkit in recent years in order to respond to sort of these short-term disruptions that we could see from a sort of shorter-term market infrastructure perspective, such as transmission protection instrument, which is specifically designed to target these sort of short market dysfunctions. But certainly the imbalances are rising, and it is increasingly important that that they are addressed.
Good, thank you for that. With that, I have no more questions in the questions tab, so I suggest that we draw the session to a close. Thank you so much for everyone for dialing in, watching, and for your patience in staying towards the end. As I'm speaking, one question just maybe sneaks under the radar here. Oh, okay, good. In fact, the question about the slides. So I did say at the beginning, yeah, the slides were downloadable. So I think you should be seeing on screen now a download button. Now we did have problems with the speed of download earlier, but hopefully you should be able to download now and get that onto your devices. Hope that works. But look, thank you, Carlo, Eiko, Thomas, for your splendid comments covering some pretty broad macro and political and economic themes. I think we did a great job. Clearly, this is a movable feast. Nothing stays the same. So one thing you can be guaranteed of is that we at Scope are watching very carefully all of the developments that we outlined in the presentation, and to the extent that we think is appropriate to update our comments, we will certainly do so. So look out for further event announcements, and hopefully we will be back soon. So thanks again to everyone, and I wish you a very successful rest of the afternoon.
Thank you.
Thank you.